We've got Madan Sabnavis, who's the chief economist at CARE Ratings, who now joins us on the show. Madan, morning, great to have you with us. First up, give us your initial reaction to the numbers. An extreme shocker at that.
Yeah, definitely this is another shocker coming after the IIP numbers of last week. I think this number has come as a shocker because we were actually expecting inflation to sort of tone down in this particular month. But the fact that we've also got a revised estimate of some in the region of 7.2% for February, or rather for March, it actually indicates that inflation is something which has not really been tamed. And I think the Monetary Authority should seriously look at its options now, because last month, when we did see a downward revision in the interest rates from the RBI, the presumption was that inflation was moving downwards. But now it appears that this was a misnomer and that inflation has not really been brought under control. And more interestingly, I think it's that the core inflation number seems to have moved up again. So I think that's something which the RBI should be taking a harder look at.
Madan, the number has come in much above even the highest of the estimates, that was around 7%. Apart from that, see, how do you see this going? Because, you know, a lot of factors depend now. See, because oil, there's the rupee which is continuously depreciating against the dollar. You have the oil prices which are going up. The administered oil products are not changed. You know, government, because of the fiscal consolidation, needs to go ahead and revise the fuel prices. So how do you see inflation moving now? Because all these cost pressures are still there as part of the economy currently.
No, in fact, I think the situation is fairly grim because we're talking of the month of April. Now, the important thing here is that we have come towards the end of the Rabi season. So there's only going to be residual harvest coming out in the next few months, which really means that food inflation will continue to be at these kind of elevated levels even going ahead. Now, as we are talking of fuel prices, while the international price of crude oil has sort of tempered downwards and is very unstably stable because it's coming down, but one is not quite sure about whether it's going to start rising again. I think the Ministry of Petroleum as well as Ministry of Finance will have a tough call there on revising the so-called administered prices, because in this kind of a scenario where inflation of around 7%, and I think any kind of revision is going to have a very, very positive impact on inflation in the sense that it's going to keep increasing it, because even a 10% increase in the prices of the fuel products will actually translate into something like 0.5 to 0.75% direct increase in inflation, plus maybe another 0.5% increase in the indirect costs through transportation. So I think this is going to be a major concern going ahead, and even in terms of core inflation, the fact that the rupee is depreciating is going to start feeding back into that particular number of manufactured products. So on the whole, I think inflation will continue to remain at this kind of a level for the next couple of months.
Indranil Pan also, who's the chief economist at Kotak Mahindra Bank, joins in now on this discussion. Indranil, first, just your initial reaction on the numbers. This was above the expectations that you were also working with?
Yeah, we were working with 6.8 expectation. It is definitely higher than the expected levels. I am really not sure what the internals are looking like, but my bet would be that the manufactured is possibly higher than what we were expecting.
That's absolutely right. In fact, for the manufactured number, actually, Indranil, I'll just run you through the numbers once again. 5.1% is what has come in, vis-a-vis 4.8% for the month of March. And it's the food articles as well as fuel group, which is the culprit once again. In fact, fuel group at 11%. And the food articles number at about 10.5% are the key drivers for the higher number this time around. But given, you know, how we have this dichotomous move going on, internationally we've got crude prices which have been easing off, which are at 5-month lows globally. But the fact that we've got currency depreciation really, you know, gripping on to the currency at least in the Indian subcontinent, that's not letting that translate into any sort of relief for the Indian consumers.
Absolutely. I think you have sort of framed your answer also in a sense. And I think this is the policy dilemma that the Reserve Bank would be possibly having, that they were waiting for the oil prices to actually come off, but it is not immediately translating into any benefit because we have a currency depreciation. And the currency depreciation can't be allowed for a very significant period because that would have inflation issues attached to it. But if the RBI tries and contain the currency depreciation, it will directly lead to a rupee liquidity shortage. So I think there's a sort of a chain reaction that is there everywhere, and this is where the problem lies for the domestic fundamentals at this point in time.
But Indranil, you just said that, in terms of the oil prices not cooling off, the government is waiting for that to cool off. Clearly, which are the other upside risks that you see as far as inflation is concerned? Because the street anticipated much lower numbers to come in, but this is clearly a big shocker that came in.
I think the supply side issues for the Indian economy is something that we really need to work on. Agricultural productivity is an issue, and unless we sort of improve our agricultural productivity and boost our agricultural production overall, it is very difficult to see the food price inflation sort of cooling off. That's number one. The number two is that the flagship programs like the MNREGA, etc., has created a sort of a wage price spiral, which would be very difficult to break for the Reserve Bank of India. So that continues to give an upward bias in terms of the inflation pressures for the domestic economy. The only way, again, it can be broken is if the overall sort of supply dynamics increase in a very significant way. And the third obvious issue is that India would possibly need a slice of luck at this point in time. And by that, what I'm sort of trying to make out is some sort of cooling off of the oil pressures internationally, some sort of containment of the problems that we are seeing in the European region, which would also possibly help the currency depreciation to sort of revert to a certain extent. So it is a confluence of not only domestic factors, but we need some luck out of the international sort of situation also.
Would also like to bring on board Rajat Bose then of RajatKBose.com, who's with us from our Kolkata studio with a feel of what's happening across the markets right now. Rajat, on the back of those numbers, we had the markets, in fact, the Nifty at least slipping below that 4,900 mark. It's just about moved back into the above that 4,900 territory right now. But what do you think is happening at this point in time? Do you think that this sell-off is likely to, become much worse as we go through the rest of the day?
It would not turn much worse because we are already coming into a very strong support area, and that support area would be found somewhere around 48.70 or say 48.50 kind of levels. So below 4,900 you would expect some support to come in. But one thing needs to be said here is that Nifty has reacted during the day from a very significant range, that is just above 49.50. In fact, so long as the Nifty does not cross 49.50 to about 49.95 supply zone, you can expect further downsides from here. And from a technical point of view, I would say that I'm not expecting the bottom to happen immediately. It would happen somewhere, say around May 28th to about May 26th kind of time period. Around that time, a possible bottom would be found. And for that bottom, I'm expecting, say, something like 48.50 to about 47.50. That is the range within which a probable bottom is likely to be formed. So at higher levels, expect more selling, and any recovery, if you expect it to sustain, at least let it cross the supply zone between 49.50 to about 49.95. And banks, especially stocks like Axis, which moved up on last Friday quite strongly, are likely targets. In fact, my expectation is that Axis could well fall below 900 mark going forward before the final bottom in this month happens.
I'll just pick it up from where you said Axis Bank, but the entire Bank Nifty, the Bank X, both of them cracked post the inflation number came more than 1% down. 92.45 is where the Bank Nifty is currently trading. How would you play on the Bank Nifty, because that's where most of the action is happening today?
Darshan, I would say that once 9,300 is broken by the Bank Nifty, that means once again it has entered into a weak territory where bears would actually press more sells. And as I said, that those stocks which had shown some recovery earlier, like Axis, would be chosen by bears or those who want to sell. They would sell. So here, what I'm expecting is that going forward, the Bank Nifty would bottom out somewhere around, say, 9,000 to about 8,700 levels. So there is a possibility of a good fall in the banking sector. But what one needs to get out of at this juncture, it is pretty counterintuitive, but in my studies what I have found is that FMCG is the sector where you should actually book your profits, because a lot of people have made money there and they should book their profits. But this sector that is coming under so much fire, that is the banking sector, at lower levels you would expect a lot of buying to come in and there could be a good bounce back. But FMCG would not show you that kind of a bounce back. It has actually given signals of an intermediate top that is not likely to be bettered anytime soon.